usually it's very difficult to do a session post-lunch, right? But we'll try to keep it interesting so that everybody can have a good time here. So maybe we can directly jump onto the topic. And Vinay, maybe I'll start with you, given you guys have been the forefront of D2C funding, starting from Mama to Boat and all of that, right? And maybe you want to give a background on why D2C funding, right? There has been so much traditional consumer businesses, but Fireside was the first one who picked up that theme and sort of went after that. And maybe you want to give some background on how you guys thought about this whole digital wave and how this D2C funding sort of played that part.
Yeah, sure. I mean, we've got the experts who actually build D2C brands here who can talk much more in depth about it. But back in the day, in 2015-16, at least where we stood, we saw that we had about 40-50 million internet shoppers, about 250 internet users in India. A lot of them were millennials. And they had grown up on media, which was social media, YouTube, etc., which was very different from the previous generation. Therefore, their habits, attitudes towards products, categories were quite different. And I think the confluence of that kind of was a great opportunity to invest in new age brands that would access these consumers mentally and in terms of availability very differently from the incumbent brands. That was the real opportunity. I think within that, what are the categories, how do you position a brand, etc. I think Aman, Varun, all of these guys have taught us much more. So, but that was really where the gap was.
Right. Now, I think just Amit, following up on the same question, right? Given you have recently set up your own VC fund and sort of started investing, and where your size of investment is maybe earlier than what Fireside or Stellaris may do, and at your time, right, when you look at a company to fund it, it's slightly on an early, right? So for you to look at parameters, like how do you sort of evaluate a company when, if you have to invest in a D2C, because I was talking to you during the lunch, you have funded a lot of D2C companies in various categories, from home furnishing to food now, right? So how do you sort of go about those categories and sort of, or the parameters when you look at from a funding perspective?
Absolutely. So there are a few parameters which are very common for all the kind of startups, even if it is D2C or non-D2C, which is market size, what is the potential of that company, how the market looks like, persona of the customer, etc., etc. But being a chartered accountant, always I believe in the numbers. So in D2C, the numbers, either it can be projection or the past number. For me, it is very important that how the gross margins look like for that company, what is the ROAS, what is the break-even point, what will happen in case the subsequent round doesn't happen, because being a early stage investor, the worry for us is that what happen if someone like Big Giant will not invest in that company, or what will be happen. So these are few parameters which are very important. So if I will have to summarize, gross margins, ROAS, and the break-even point, these are the three main parameters which we always look before investing in any company.
So I'll just summarize, right? Gross margin, ROAS, break-even point. And I'll come back to you on those 3 points back again. Rahul, maybe I'll take it to you before Harini and sort of Puru, I'll come back to you. How important is the entrepreneur in this, right? The numbers is one important part, right? And I keep on hearing this from all the VCs, right? Entrepreneurs come first, right? It is the entrepreneur we are backing, right? And when you evaluate a transaction, right? Obviously, that is the critical part, but what are the characteristics you look from an entrepreneur saying, this is the guy I want to back? And is it only the problem, or is it the entrepreneur, right? That's the question which I wanted to understand.
So, if I can just elevate the question, I think the space itself has very low entry barriers, right? As in, anybody can start a brand, and hence, at least in our view, the only moat a company has is the brand that you build. It is not the product at the end stage, not initially, but at the end stage. So what we look for when we are talking to founders is, do they understand and appreciate that while there is revenue numbers and all to be shown, is there a real brand being built in minds of the consumer? And I know it is in early days, very hard because, there are so many constraints, they don't have budgets and all, but at least the thinking around brand, which means the products that you build, the focus you have, pricing you have, understanding of consumer segment, that is what matters to us much more. And in that sense, you will see there is a little bit of science and a little bit of art in, the kind of founders you end up backing compared to a lot of other consumer tech companies that we end up backing.
Interesting, interesting. Puru, maybe now I'll pick it up with you. I think you had a phenomenal journey, right? You started a company, raised capital, went and finally did an exit and partnered with a strategic investor. Maybe you want to share your experience and how you build it up, the type of challenges which you faced during, whether it's fundraising, what are the mistakes a founder should not do, right? Some of those, I know there are multiple of those questions, but maybe you can take first your journey part and then we can get into some of those there.
Okay. I mean, if I start answering in detail, it'll take probably 1.5 hours just to answer.
You don't have that much time.
Yeah. So I mean, just for everyone, we as a brand are a foods brand. We essentially are in breakfast and snacks. Related to fund journey, I think we've had an interesting set of 3 different types of investors, apart from the angel investors who invested. The first one was a family office. It was RPG Ventures, RPSG Ventures, the first one that they invested. Second one was a government welfare fund, and third one was an FMCG company, Marico, who sort of invested. So all 3 have had different, yardsticks. All 3 have had different ways to decide. So as Rahul said, the component of art and science varied with all of them in a very different manner. And what we learned along the journey was that the metrics for each of them was very different. What they measured, what they looked at, how they evaluated the business, and what made them invest in us and what made them invest out of us were also very, very different. So that has been a very different experience. I think the biggest thing that I think, just to address the mistakes, I think what we have also learned over the journey is when should you really raise funds, because I think it's in vogue these days. People start a company to think that I will raise funds and buy a car from it. So I think that's a very different notion. Very few entrepreneurs, when they raise money or they try to raise money, they realize why should they raise money. And I've had investor friends who come back and say that they don't even know why they want to raise money. They just want to raise money. So I think that's something which is critical. Why you raise money and when should you raise money? It's a very, if I start talking, it'll be a long one. But I think those principles are very clear for any founder to sort of understand. And from whatever we've experienced, even, the experts sitting here, but even when they look at it, they also want a very clear reason why you want to raise money. And for what reason are you raising money? If that reason is not convincing enough, probably they'll come back and tell you that we love you, but sorry for now, or they'll give you 10 other reasons. But the fact is they haven't been convincing enough, or you haven't been convincing enough. That's the reason that probably they refuse.
Sure, interesting. Harini, maybe just building on what Puru was saying, right? You have sort of built a business, raised capital from venture capital. What was the trigger, first of all, right, when you realized that this is the right time for you to raise capital? And during your raising capital, what were the key learnings you found during those times?
Good afternoon, everybody. Firstly, thank you for having me here, and I'm extremely honored to be here today with a great panel, specifically Vinay, Rahul, who I've interacted along the journey while I was building my brand. So to answer, I think as an entrepreneur, what Puru said is 100% right. You should know when to raise a capital. You should not be raising capital just for the sake of FOMO, or because, or you have a plan to probably run a business based on fundraising. That's extremely, a very wrong route to take. In my opinion, actually, from my own learnings, if I have to say, fundraising happened on its own for me, right? I was an accidental entrepreneur. I'd like to, honestly admit that I was an accidental entrepreneur. It was not a planned venture. It's a passion project that turned into business. And suddenly when investors started speaking to me, I started understanding why an investor wanted to invest in a business at all, right? It was interesting for me to even understand, because each investor has a different outlook towards how they look at business, right? Somebody's looking at founder passion, somebody's looking at numbers, somebody's looking at, whether the market is building towards that product or not. And there's so many parameters out of which I think as a founder, you need to be cautious enough to figure out who is that one person who will help you along this journey, or who will walk along with you in this journey. That's extremely critical. And I think for me, a lot of learnings along the way. One was, I think, probably fundraising too early in the beginning stages is not a good idea. That was my first learning. Maybe you should, today, I think, you have a lot of other means to, probably finance your business, maybe revenue-based financing, maybe debt funding, a lot of things, loans that you can take, or just, onboard an angel investor as well. And then learn how the business is shaping up, where it is going to, and then probably at the right time, figuring out when to bring an investor is extremely critical. That was my first biggest learning in this journey. The second one was to, like Puru said, product. I think Rahul said that product is extremely critical. Business, I think today, the entry barriers are so low that there is every single product has a customer. And hence, if your product is strong, ultimately you will be able to attract the audience, the investors, and so on and so forth. So that's the second thing. So instead of, probably investing on day one on marketing and everything, we spend a lot of time on building the product, which it took us a long time to realize the benefits out of it. But it is a sustained growth when you do it that way, rather than probably, just building on the brand name and trying to push, and then there is a spike and then a fall. So these are, I think, two important things I learned along the journey.
So product market fit is very, very important, right? That's it. Vinay, building on what the two founders sort of talked about, when do they raise funds, right? But I think one of the key discussions which you always have in a VC group, or even the bankers group, or in the founders group, a lot of money which is raised today goes back to Google, Facebook, right? And they are the one who's actually getting more benefit compared to the company which is there a moat, right, which is getting created, or is it just the digital marketing which is sort of great? So from a perspective, if you are a VC, when you invest to a founder, right, what are the moats you look into that? And in this rise of cost of acquisition, how does or maybe the easier way today, how does a founder build a moat today in this sort of high cost of acquisition which is happening today?
I think, in the wave one of digital brands, I think it is a white space. Incumbents were not really active on Google and Facebook and Amazon. And whoever moved first had a huge first mover advantage because they occupied first page positions on Google, on Amazon. They could very quickly, at a very cheap cost, get a very large audience of buyers from Facebook and then build a critical mass on top of that. Today, the pendulum is swung the other way. There are a lot more new brands. And more importantly, I think post the pandemic, after offline business shut down, a lot of incumbents recalibrated their strategies to say, hey, we need to be more aggressive. And as they say, like when the elephant moves, the jungle trembles, right? So digital marketing costs have really gone through the roof because all those dollars are chasing the same 20, 30, 40 million eyeballs. And they call it a bidding system, and obviously, therefore, the cost goes up. I think in this environment, I would 100% second what Harini just said. I think product is super important. I think, but one step before that, who is your customer is a super important question to answer, because you can build $100 million business today in your lifetime, acquiring 2 million customers, selling 5 times to them in a year at $10 a pop. And those are businesses that are high retention, sticky businesses that investors really love, because the lifetime CAC of that business is only 2 million into whatever is the current CAC cost. And therefore, if retention has to be built into your business model, product becomes a key moat, which makes consumers come back to you. But for that, you need to understand who your customer, who your subsegment is. If a founder comes into the room and says, hey, I am appealing to female 25 to 35, my recommendation always is, hey, dig a little deeper, and who is this female has to be answered. I think the second moat that a lot of entrepreneurs today are building into the business is the business model in itself, which is about saying, can I get into categories, can I get into segments which have a natural affinity for high retention? And therefore, can I build direct, while I will pay the toll to Mark Zuckerberg or Sundar Pichai, but once I pay that toll, can I keep having an ongoing first-party relationship with my customer that allows me to build a fairly profitable business model. And we've seen that time and again, a bunch of wellness sectors. Plix just got acquired, and I'm sure there are reasons why it did. And therefore, that's the second moat. I think the third moat that we look for is entrepreneur as a moat, right? Can you have the leadership capabilities to inspire confidence in your early team members to join your, Andolan? And can you inspire confidence in partners to trust you when you are small? Because everybody trusts the big guy. Can you have the charisma to walk into, investor rooms, to Amit's point, and raise capital in future rounds whenever the business should require it? I think those are three modes that still are very much available, and that's what we look for.
So you product market fit, entrepreneur, and finally the
Business model.
Business model. The three one of them. Yeah. Coming. Okay. Amit, maybe the same question to you, maybe a slightly different way to look at it, because in your stage when you are investing, right? Retention, cohorts are obviously not there. I know you talked about your gross margin, the break-even point and everything, and largely now at that stage you are betting on an entrepreneur, right? If suppose the same company comes to you, because when Fireside probably look at Stellaris, look at maybe it's like a 2 years down the line, they have a proven business model, right? Now, at that point of time, obviously you will do a market assessment, thesis, sort of challenge some of this, but what are the other things you will look at it before if you sort of say, okay, fine, I think this is the company? Because, and the other category, which is I think that I will come to later, is this whole omni-channel piece, because a lot of these D2C brands now are saying we are omni-channel because our food as a category or everything, and I know you have invested in one of the food categories. How is that much critical for your sort of, from an investment thesis, when you look at it?
Yeah, definitely. Omni-channel is an important thing which everyone will have to follow. But at the stage where we are coming, where we are investing between $250,000 US to $500,000 US, so none of our company can afford the stock which is required in the offline business. So our focus is very simple, and we suggest to our founders that be focus on the online first, brand only first, because at the initial stage, founders need lots of learning about the product itself. The product can't be right on the very first day itself. There lots of pivot or corrections are required in the product. So it is better, rather than going offline, be online, identify the customer requirement, correct the product, improve the product, and make sure that the product is something which is loved by the consumer, rather than every time you are increasing the SKU. Another criteria for us to understand the hero products of our portfolio company as well. Whenever they come to us, we find out the mode that which are the products which are doing well. In case there is a company who have 100 SKUs versus there is another company with the same kind of sales they are doing with 10 SKUs, we always prefer to have company with less SKUs because inventory is not required at high stage. So these are the few parameters on which we assess. So in case I have to summarize it, pivot or correction in the product is very important for us to understand, and definitely we always suggest to be the digital first. Sometimes founders confuse with D2C terminology itself. They treat that in case you are selling through your own website, that is only D2C. That is not the case in our case. We always said that sell through marketplace as well. So there is two concepts. Either you can open your own shop, or there can be shopping mall where you can have your stock lying there. So start trying with the marketplaces, identify the mistakes, correct the product, then focus on your own website. And sometimes founders say that in case I will go to the marketplace, I will have to pay 30% to the marketplace owner itself. I always suggest give that. That's not a problem. Ultimately, people are coming to identify that product or to buy that product, rather than you are bringing the customer to your own website. So these are the few parameters on which we assess whether we want to enter into that company or not.
Sure. Amit, no, very valid point. Harini, again, I'll have to skip you, but this is a question I wanted to take Rahul, and the same question I'll take it back to you. D2C versus marketplace. There's a lot of debate when your VC looks at it, and because in the marketplace you don't, end of the day, whole digitally native is that you're able to track the customer data, you know what your customer is buying, but in the marketplace you're not able to track, right? What is important when you look at a company? how important is that today if I have a company which is 20% D2C with 80% marketplace, a company which is 80% D2C with 20% marketplace, how will you sort of evaluate both of them? Which one you think is the better? Because one of them to get an 80% D2C may be burning a lot of capital, right? Because as cost of acquisitions is going up, right? How do you evaluate, Rahul, from your side when you have to look at between D2C and marketplace from a balance perspective?
Actually, for me, it doesn't matter. Because different channels serve different purposes. If you tell me I'm a brand who only operates through my own stores, but I don't want to sell, inside, let's say, Shoppers Stop or some other multi-brand retail, it will be strange. Why will you not sell where the customer is going? So I would say different channels have different purposes. Obviously, D2C has the advantage that you get customer data, but it's also expensive. But also another advantage that you can retain the customer on the website. Amazon and Flipkart are where everybody is going, right? The amount of traffic they have. If you are not there, then you are losing out on all that business also. So I think you need to have a mix, and similarly, offline also has a role to play. At different stages of business, you figure out what is more important. In some cases, like say in beauty and personal care, being on Amazon on day one is very important, because if you are behind in terms of building out the reviews of a particular SKU, it is very hard to come from behind. If you are in fashion, that advantage is not there because your SKU changes, right? So there is no rating you're building for the SKU, but you're building for the brand per se maybe, but not for the SKU. So it also is very different for different categories. And hence, I would rather, gaze whether the brand is finding resonance with the customer or not when we are entering. And we have seen companies who are 95% D2C and then build a very good third marketplace business, or the other way around as well.
Very interesting point. And Harini, the same question, right? Because you are on Amazon, right? Where there are some 10,000 beauty brands today, right? And competing there. And obviously there is a cost of acquisition which you continue to spend. How do you see that part? Because you may not get the customer data, right? We heard what Rahul said from his point of view. What about your point of view, right? When you are building a business, you are present on a marketplace. The cost of acquisition is still high. How do you do that? And there are you competing with 10,000 brands today on Amazon.
Absolutely. So first is for a brand that is coming out into the marketplace is very critical, and the reason is the access to a huge pool of customer base is lying there, and that's extremely critical for a small business to gauge on. That's number one. Number two, I think initially to build trust, a lot of customers prefer buying where there is simpler returns policy, right? Now in small businesses, we don't have the ability to probably give them that kind of a, seamless return experience, whereas an Amazon or a Flipkart or say a Myntra will give no questions asked returns policy, right? So from a consumer's perspective, they find it extremely safe to buy it from an Amazon, even if they know that the brand has, probably at 50 rupees lesser on their own website. Till they build the trust, they will go to places like Amazon and Myntra to buy that product, right? Now so from a founder's perspective, for me, while I was building the brand, I was very clear I wanted to be in every single touch point where my customer is coming. If they're coming to Instagram, I want to sell through Instagram. If they're coming to Flipkart, I want to sell in Flipkart. So that's the first point, right? But along the journey, like this is in the initial phase when you're trying to, tap on every single customer that's out there in the market. But over the period, you will need to start shifting the gear and start focusing on acquiring those customers. And that's where you build all the retention strategies. You start, doing better, strategies, discounts, deals, where consumers feel more confident to buy from the direct website itself. And once that consumer starts interacting with the brand directly, the retention and everything kicks in. And then we have that entire, access to the data that we have, which we work on going forward. So to answer your question straight, I think it's highly important to be on both these places. And, probably along the line, start focusing on building your own, probably channel much more stronger, either by building your own stronger website or by going offline, however you want to do it. But initial stages, it's a good advantage if you're there on the marketplace.
If I may add one more thing, one other thing which we have realized is there is a seasonality to these channels also. So in October, November, Amazon is spending like crazy. Why will you not take advantage of that channel? And then there are months where they don't want to spend, and that is the time for the D2C channel to expand, right?
Fair point. Fair point. I think channel is important. I think, Puru, for you, it's a very different category altogether, right? D2C, quick commerce, marketplace, offline, neighborhood store. How does, from a True Elements perspective, because it's a food category, how does that work?
Okay, so incidentally, just for reference, we started True Elements as a private label of an e-commerce platform. There was a platform called healthyworld.in that we ran, and True Elements was a private label. But the reason we switched or we inversed the pendulum was because we started selling on Amazon. And suddenly we saw the kind of traction that Amazon gave to us was phenomenal. The number of people visiting the website, I'll make it short. So the number of people visiting were far higher. And I disagree on the data piece because we've been on Amazon for close to 11 years now. And I think the kind of democratic data that Amazon provides is amazing. Right to the level of, we've gone because we were a marketplace on Amazon. So that gives you an edge of every single customer, these days you have much more data than what Amazon had 10 years back. But that gave us a very strong edge on how to look at our customers and their journey. More importantly, the category we operate in is grocery. We are not a gourmet brand, even though we started thinking we are a gourmet, but we are actually a grocery as we are growing. So when you're a grocery brand, you need to be there in the basket of what people are buying. People don't go to a website especially to buy grocery stuff. They will buy grocery, and if you're part of that basket, they'll probably choose you if you are one of them. We might think people have a lot of brand love and everything. It does not happen so easily. It's just that if you are one of those brands who I'm thinking about when I'm buying a category and I have some familiarity with you, you're probably going to be in my basket. That is a principle we have used, and that is, I think, for most food brands. I would love to learn from a brand who believes that their own website is, as a grocery brand, a phenomenal place. But our limited learning has been, if you're a grocery brand, be where the grocery is being bought, whether it is the Perchuni downstairs or it is Big Basket or Amazon, you just need to be there. That's been our learning.
Very interesting point. I think we have very short time. So the last question maybe, and we can do a quick one, maybe, and Vinay will start with you again. And this is a very question which every founder, entrepreneur is asking about this whole funding winter. Somebody saying funding summer, you don't know where is it heading to, right? What are you guys seeing this? And because I know you guys continue to invest, how are you guys looking at this sort of thing? Or have you changed your thing from where you used to investing 2 years back to now in terms of this winter season?
I think it's a mild Bangalore winter. It's not really a winter of sorts. I think our tech cousins, especially in the late stage, are facing the brunt of it. In our world of consumer brands, at least from my vantage point, I don't see any kind of winter. In fact, it's deal season big time. Especially in the early stage, with the lighthouse brands that have gotten created over the last 5 to 7 years, I think the entrepreneurial activity has been exponentially high, especially a lot of new categories, a lot of new brands getting launched in the last 2-3 years. This entrepreneurial activity has led to a lot of funding activity. We've got a bunch of early stage funds, Amit runs one of them, operating at that stage when brands probably don't have revenue but have a great idea. Post-revenue, there are a bunch of funds as well, Fireside, Stellaris being some of them. Family offices have come to the party. And what is resulting in this is founders have access to a lot more capital very early on. And because the number of internet buyers have gone up, the number of avenues to sell has gone up exponentially, Q-commerce, social commerce, etc. Entrepreneurs are able to hit a higher milestone of revenue before they need to raise institutional capital. And therefore, for us, we are seeing entrepreneurs come up for a capital fundraise much later in their life cycle than we used to 5 years ago. And that's forced our strategy to go slightly later, though we love investing earlier. So I don't think it's a funding winter, at least in our world.
Sure. I think we have run out of time, but maybe Amit and Rahul, last comments from your side on the funding winter.
So I totally echo what Vinay said, that this D2C is the sector which was least impacted by funding winter, to be very honest, because there is no much success story is as of now in the market, and lots of brands are coming and lots of funds are also coming at early stage. So definitely that's not the case, but I would like to mention one thing here. Valuation have definitely corrected, means the multiple which were there a year back, that doesn't exist, and I don't foresee that they will come back as well, which is in a way good for the market as well. So multiples have been corrected, but funds are there.
Rahul, last comment.
So incrementally, apart from what Vinay and Amit mentioned, I would say one, as a fund, we have never been impacted or tried to change our behavior based on what is happening in the environment. So as an entry point, our pace of investing has not changed. In terms of rest of the community, I would say the only thing that we have changed in our parameter is the assumption that Omnichannel is very critical part of building a large company. In terms of late stage, I don't think, at least D2C brands have been not as impacted as most of the other consumer tech sectors.
Sure. No, thank you. I think just to summarize, I think what the panel discussed, few points I think important is one, from a product perspective, I think from one sustainable business model, product market fit, and entrepreneur. I think those are the three key things what VCs are looking today. There's no funding winter, right? The winters are as sort of is normal. We still have summers going on, right? And one of the important point I think which Puru and Harini both brought up is when do you want to raise capital? I think that's very, very important. Today the type of capital, as Vinay mentioned, from a family office to sort of type the earlier entrepreneurs investing, so there's a lot of capital available. So be mindful when you raise capital, right? And I think she's an accidental entrepreneur, but she has done fantastically well, and I think that's something we all need to look for, right? I think you will be that stage when investors will chase you, but maybe that's not the right time for you raising capital there. So that's broadly where we end the session, right? Happy to take on questions which are there.